respected panelists and audience out here. Today our panel discussion will focus on monetary policy and financial crisis management. We will examine how central bank and monetary authority respond to economic crisis such as the 2008 global financial crisis and the COVID-19 pandemic. Our discussion will critically focus on monetary policy tools, financial system stability, monetary transmission mechanism, unconventional monetary policies, and future challenges facing the central bank. This topic is extremely relevant because global crises have shown that the monetary policy is no longer limited to simply controlling the inflation. Central bank today must stabilize financial market, support employment, restore investor confidence, and maintain economic growth. Now let me introduce our panelists. Our first panelist is Jamil Tide, our central banker. Will discuss monetary policy tools and monetary policy control, monetary supply control. Our second panelist is Pema Roji, our monetary economist. Will explain theoretical framework and process models. And our panelist 3 is Gary Namgil, who is a financial market analyst. Will analyze how this crisis affect financial market and policy transmission. And finally, our panelist Balan Darji, our policy critics and fintech expert, will evaluate policy, limitation, and future monetary challenges. So let us begin with our first panelist. And the first panelist will discuss and explain about the role of central banking during financial crisis.
Thank you, moderator. Central bank plays one of the most important roles during financial crisis because they are responsible for maintaining monetary stability, controlling inflation, regulating money supply, and protecting confidence in the financial system. Whenever an economy experiences a crisis, people and businesses become uncertain, investors panic, banks reduce lending, and businesses reduce production, and unemployment begins to rise. During such situations, central bank act as the first line of defense to prevent the economy from collapsing. One major example is the 2005 global financial crisis. The crisis began in the United States due to the collapse of the housing market and subprime mortgage loans. Many financial institutions faced huge losses and several banks were close to bankruptcy. This created fear throughout global financial markets. To respond to this crisis, central banks such as the Federal Reserve System and European Central Bank introduced expansionary monetary policy. The first major step was reducing policy interest rate. When central bank reduced policy interest rate, borrowing becomes cheaper, businesses can take loans more easily, consumers spend more, investments increases, and overall economic activity increases. For example, the Federal Reserve reduced interest rates close to zero during the crisis to stimulate economic recovery. However, during severe crisis, lower interest rates alone may not be enough because banks may still hesitate to lend and consumers may lose confidence. Therefore, central banks introduced unconventional monetary policies such as quantitative easing. Under quantitative easing, central bank purchased government bonds and financial assets. Liquidity in the banking system increases, commercial banks receive more money to lend, long-term interest rate decreases, and financial markets stabilize. Another important role of central bank during crisis is acting as the lender of last resort. This means providing emergency loans to commercial banks facing liquidity shortages. During the COVID-19 pandemic, central bank again reduced interest rates, expanded liquidity facilities, purchased financial assets, and coordinated with governments. These actions helped prevent financial collapse and supported economic recovery. However, expansionary monetary policies also create challenges. Finally, inflation may rise, public debt may increase, and asset bubbles may form. Therefore, policymakers must carefully balance economic recovery with long-term sustainability. In Bhutan, the Royal Monetary Authority also plays an important role in maintaining financial stability, managing inflation, and supporting economic confidence. In conclusion, central banks are essential during crisis because they stabilize financial systems, restore confidence, and support economic recovery. However, monetary policy alone is not enough. Financial policy regulations and international cooperations are necessary. Thank you.
Thank you, panelist one, Central Banker, for sharing your excellent explanation of how central bank respond during the financial crisis. Now we'll move on with the panelist two, monetary economics, who will help us to understand theoretical framework used in monetary crisis management.
Thank you, moderator. From a theoretical perspective, monetary economists use several economic frameworks to explain how monetary policy affects economics during the financial crisis. One major framework is Keynesian theory. According to Keynesian economists, the market do not always self-correct during recessions, during severe economic downturns, like consumer reduces spending, their business reduces investment, unemployment increases, and economic growth slows down. So therefore, the government and the central bank must intervene actively to stabilize the economy. So another important concept is the liquidity trap. A liquidity trap occurs when the interest rates become extremely low, but economic activity still remains weak because people avoid borrowing and investing due to fear and uncertainty. So for example, during the 2008 financial crisis and the COVID-19 pandemic, even though interest rates were close to zero, many households and businesses still reduced their spending. So this showed that the conventional monetary policy sometimes becomes less effective during severe crises. As a result, the central bank adopted unconventional monetary policies such as quantitative easing, forward guidance, and negative interest rates. Another important theoretical concept is the monetary transmission mechanism. So this explains how monetary policy decisions influence the real economy through different channels like interest rate channels, credit channels, exchange rate channels, and expectation channels. So for example, when interest rate increases and borrowing costs become very low, so it encouraging investments and consumptions. So next, another important issues during crisis is weakened their policy transmissions, like during financial crisis. So banks become risk averse, consumers lose their confidence, lending decreases, and investment slows down. So as a result, monetary policy may not produce its expected effects. So this is why the economists argue that the fiscal policy must work together with monetary policy. So I'll give an example. Government spending, their tax reductions, income support program, and stimulus packages can help increase the aggregate demand during the recessions. So during the COVID-19 period pandemic, many governments implemented that both fiscal and monetary stimulus simultaneously. So economists also study inflation expectations. If people expect inflation to rise significantly in the future, they may increase their spending today or demand higher wages and create additional inflationary pressure. So therefore, central banks must maintain their policy credibility and public confidence. Another modern issue is globalization. Today, economies are highly interconnected through trade, their capital flows, and financial markets. So as a result, monetary policy decisions made by major central banks such as Federal Reserve often affect their developing economies worldwide. For example, exchange rate fluctuate, capital flow change, and their imported may increase. So in developing countries, monetary policy may face additional inflationary. So due to like smaller financial market, limited monetary instruments, and dependence on the external sectors. So in Bhutan, monetary policy is also influenced by the exchange rate arrangements and economic dependence on neighboring economies. So therefore, the economists will believe that the monetary policy must be flexible and coordinated and adaptive to changing their global conditions. So in conclusion, our theoretical framework helps us to understand on how monetary policy works, why crisis occurs, and why policy coordination is necessary during the economic instability. Thank you.
Thank you, panelists to Monetary Economics, for your insightful presentation in today's panel discussion. Now we'll go with panelist 3, financial market analyst who will help us in understanding financial crisis and monetary transmission.
Thank you, moderator. Financial crisis directly affect financial market and become the monetary transmission mechanism. Normally, when central bank reduce interest rate, bank increase lending, business invest more, consumer spend more, and economic activity improves. However, during financial crisis, this process become inefficient. For example, during the 2008 global financial crisis, many banks suffered large losses from subprime mortgage assets. As a result, banks become cautious and reduce lending despite low interest rate. This becomes the critical channel of monetary transmission. Financial crisis also create instability in financial market. During crisis, we often observe falling stock price, currency volatility, declining investor confidence, rising unemployment, and reduced business activity. One major issue is systematic risks. Systematic risks occurs when the failure of one major financial institution threatens the stability of the entire financial system. For example, the collapse of large investment bank during the 2008 crisis created panic throughout global market. To prevent further collapse, central bank introduced emergency liquidity facility and asset purchase programs. These measures help stabilize markets and restore investor confidence. During the COVID-19 pandemic, financial market again experienced several uncertainty. Many industries such as tourism, aviation, hospitality faced sharp decline due to lockdown and supply chain disruption. Central bank responded aggressively by reducing interest rate, expanding liquidity support, purchasing government bonds, and supporting credit markets. As a result, financial markets recovered relatively quickly. However, some analysts argue that this intervention also increased asset price inflation. For example, stock market recovered rapidly, housing price increased, and wealth inequality widened. This happened because asset owners benefited more from rising financial asset price. Another important issue is investor psychology. Financial markets are strongly influenced by expectation and confidence. When investors fear economic instability, they sell risky assets, reduce investment, and move funds into safer assets. Therefore, maintaining confidence is extremely important during crisis. Financial analysts also study market interconnectedness. Today, global financial systems are highly connected. Problem in one country can quickly spread to other economic through banking system, capital market, trade, and investor behavior. This increases the risk of global financial contagion. Another growing challenge is technological transformation in financial market. Digital banking, online trading, cryptocurrencies, and fintech innovations are changing how financial systems operate. While technology increases efficiency, it may also create cybersecurity risks, financial volatility, and regulatory challenges. Therefore, policymakers and financial institutions must strengthen financial regulation and risk management system. In Bhutan, managing financial system is also important because economic shock in neighboring countries may affect trade, inflation, and exchange rate. In conclusion, financial risks significantly disrupt monetary transmission and financial stability. Central bank intervention can also stabilize market, but policymakers must also address. For the long-term risks, it must also address where inequality, asset bubbles, and systematic vulnerability must also get addressed too. Thank you.
Thank you, panelist 3, financial market analyst, for your detailed analysis of financial crisis affect market and market transmission. Now, moving on with our last panelist, fintech expert. He will give us overview of challenges and future of monetary policy.
Thank you. Although monetary policy is an essential economic tool, policymakers face many challenges, constraints, and future uncertainties. One major challenge is the trade-off between inflation control and economic growth. When inflation rate rises, central banks usually increase interest rate to reduce spending and stabilize price. However, higher interest rates may also reduce investment, slow economic growth, increase unemployment, and weakens business activities. This creates a difficult policy dilemma. Another important issue is central bank independence. Governments may sometimes pressure central banks to maintain low interest rates before election in order to stimulate short-term economic growth. However, political interference can reduce policy credibility and weakens investor confidence. Therefore, central bank must remain independent, transparent, and accountable. Here, globalization is also create challenges for monetary policy. Today, economies are highly interconnected. Decisions made by major central banks such as the Federal Reserve System can affect developing economics through exchange rate, through capital inflows, inflations, and financial market volatility. For example, when interest rates rise in advanced economies, investors may move capital away from developing countries, causing currency depreciations and economic instability. Another major challenge is rising public debt. During crisis, government often borrow heavily to finance and stimulus packages and economic support programs. While this may support short-term recovery. Excessive debt can create long-term financial pressures. In addition, prolonged expansionary monetary policy can create financial imbalance such as asset bubbles, excessive risk-taking, and rising inequality. Well, one of the most important future development is financial technology, or it is also known as fintech innovation. Today, digital payments are expanding, online banking is increasing, cryptocurrency are emerging, and financial services are becoming more digitalized. Many countries are also exploring central bank digital currency (CBDC), commercial central bank that is known as CBDC. As for example, China's digital yuan project demonstrates how central banks may modernize payment systems using digital currency technology. However, cryptocurrency also creates challenges for monetary authorities. Decentralized currency reduces central bank control over money supply and financial transactions. While then this may weaken monetary policy effectiveness and create regulatory concerns, another important issue is cybersecurity. While then as financial systems become increasingly digital, risks related to cybersecurity, we have data privacy, financial fraud, and technological disruptions becomes more serious. Therefore, future monetary policy must combine economic stability, technology innovations, and financial regulations, and also cybersecurity protection. Climate change is also becoming an emerging concern for central bank. Natural disasters and environmental risks may affect financial market, insurance systems, and also agriculture productions and economic stability. As a result, some central banks are beginning to incorporate climate-related financial risks into policy frameworks. In Bhutan, digital informations and economic modernizations are also increasing. Therefore, financial authority must carefully manage innovations while maintaining monetary policy stability and financial security. Moving to the conclusions, the future of monetary policy will become more complex due to globalizations, we have technological innovations, we have financial interconnectedness, and changing economic conditions. Central bank must remain flexible, it must remain independent and forward-looking to maintain stability in modern economics. Thank you.
Thank you, panelists, for vintage expert for sharing the expert of your thoughts and discussion for the future challenges of monetary policy. Now, thank you all the panelists. And now let us move into an interactive discussion session. My first question is, do you think unconventional monetary policy like quantitative easing were truly successful after the 2008 crisis?
Yes, unconventional monetary policies like quantitative easing were truly successful after the 2008 crisis because they prevented economic collapse and restored liquidity.
I believe it was partially successful as they stabilized market but also increased inequality and public debt.
And I also agree, the financial market recovered, but long-term structural problem remained unresolved.
Thank you for your answer. Now, moving on with the second question. Can monetary policy alone solve financial crisis?
No, moderator. Monetary policy cannot solve all financial crises by alone. So I think the monetary policy is very important, but the fiscal policy and the government are also equally important to make the financial stability.
Exactly. During COVID-19, stimulus packages and fiscal support worked alongside monetary policy.
Thank you for your answer. Now moving on with the third question. What is the biggest future challenges for the central bank?
The biggest future challenges for the central bank could be digital currency and maintaining policy credibility.
Another biggest challenges can be global financial interconnectedness and external shocks.
I think managing inflation without precision will be the most challenges for the future.
Thank you for your answer. Now we came to an end of our panel discussion. Now we offer the floor to the audience in order to ask the question if you have.
My question is, why do central banks reduce interest rate during crisis?
Thank you for your question. Central banks reduce interest rates during crisis to encourage borrowing, investment, and consumption, which stimulates economic activity.
My question is, what are the risks of quantitative easing?
Thank you for your question. The risks of quantitative easing, it may create inflation, asset bubble, and increase inequality.
Can Bhutan use unconventional monetary policies?
Thank you very much for your wonderful questions. So our Bhutan's financial market is very small, and so unconventional policies may have limited effectiveness compared to larger countries. So however, the selective liquidity supports and the monetary coordinations can still be useful for our country.
To conclude, today's discussion highlights the monetary policy play a vital role during financial crisis. Central banks use both conventional and unconventional tools to stabilize the economy, restore liquidity, and support financial system. However, our discussion also showed that monetary policy has limitations. Policymakers face challenges such as inflation growth, trade-off, and political pressure, financial instability, and technological transformation. As the global economy evolves, monetary authority must continuously adapt the strategy while maintaining financial stability. Thank you everyone for your attention. We hope this discussion proved meaningful insight into complementary issues in monetary policy.